When you borrow to invest, you are said to be leveraging, which basically gives you the ability to have a greater exposure to an asset than you would otherwise be able to have if you just invested your savings or surplus cash flow. So for example, if your goal was to have $1 million stock portfolio, well, you can do it two ways. You can either save up surplus cash flow, regularly invest to get your $1 million portfolio over time, or you can borrow $1 million and put that money into a portfolio and have your $1 million portfolio overnight. Now you're probably sitting there thinking, Brad, don't be stupid. It's not the same thing. If you have $1 million portfolio, but you got $1 million of debt, well, you should be taking that $1 million of debt off the value of the $1 million portfolio to work out your net asset position. And you would be 100% correct in saying that. However, the difference between these scenarios is that when you borrow money to get that $1 million portfolio, you're getting returns on $1 million immediately. Let's say the interest on that $1 million loan is 6%, which would cost you about $60,000 a year, assuming interest-only repayments for the time being. Now, if your share portfolio earns 8%, that's $80,000 a year of returns before taxes and fees, giving you a $20,000 margin. Alternatively, the $60,000 it costs to service the loan, let's just for argument's sake say that you could have invested that money into the market instead without any debt. If you still earn an 8% return on the $60,000 invested, you would have only generated $4,800 for the year, which is substantially less than the net margin you got from using leverage. Now, of course, there is a flip side. So whenever you use leverage, you are basically betting that you can generate a higher return on what you're investing in than the interest rate on the loan. So let's say, for instance, that the investment only generated 4% and it's still costing you 6% to service that loan. Well, instead of making a $20,000 gain in the year, you've made a $20,000 loss. So debt and leverage really just magnifies the outcome. But the reason why this is a lower interest rate is beneficial is because it means that the break-even point in order for you to start making money is much lower when the interest rate is lower.